The US economy shows no signs of slowing. Indeed, it's firing on all 12 cylinders. Fourth quarter GDP is expected at 3.3% quarter on quarter. And at this stage of the year, the S&P 500 is up 60% over 2 years, ex-dividends, and the Nasdaq has doubled in the same period. 2025 is approaching. Are we going to get more of the same, or should we be adjusting our portfolios? Francois, hello.
Hello.
Nice to see you. Thank you for joining us. Let's look at the US stocks first of all. Which of the sectors you prefer the most? Let's start off with the small and mid caps, please.
Cap, I think, is a very interesting segment in 2025. But nevertheless, I would caution that with one element is the interest rates. On the one side, you have elements in Trump's program that are very supportive for mid and small cap companies, which are deregulation plus tariff plus the fact that you could have lower tax rate in the US. Nevertheless, there is something that you need to keep in mind. Depending on how Mr. Trump is going to put his agenda in place, it can be a bit shaky and it could induce some tension on interest rates. Why so? Because if he goes first for tariffs, it could impact the inflation numbers in the US, which could weigh on the bond market. You know, small and mid-cap companies have quite a lot of debt. It would not necessarily be very positive for them to have higher interest rate. So I still believe that small and mid cap are interesting in 2025, but I would check what is going to happen with interest rates. It's very important to my point of view, but I would overweight the small and mid cap companies in a portfolio.
Is that something that you would continue to do or that you would increase going into 2025?
If you remember, we talked about small and mid-cap companies in the last few months, and quite a few months ago, I told you that I was a believer in the fact that there could be some rebound and that the underperformance of small and mid-cap was too big to be justified. So I would stick with what I have decided earlier, but I still think that you need to keep a good position in small and mid-cap companies.
Let's turn to big tech now. What are your thoughts on that?
Big tech, Magnificent Seven, and everything. I think that people need to be aware that 2025 seems, to my point of view, to be a year where volatility is going to be higher than it was this year. In this context, I believe that you have the opportunity to get some of your chips out of the Magnificent Seven. It doesn't mean that you need to be underweight those stocks and that you need to sell everything, but I think that to book some profit and to diversify your portfolio out of those sectors to try to find some natural hedge on the equity market is something that is interesting for the coming months.
What about pharma now?
I think that pharma is a candidate when you consider the poor performance of the pharma and healthcare sector in general over the last 2 years. I think that you have an opportunity there if you book some profit and you want to look for a natural edge of your portfolio on the equity side. I think that to have some exposure and to increase your exposure to the healthcare sector is something I would recommend.
Right, let's turn to consumer staples and consumer durables now.
Consumer staples, a very difficult period for the segment, considering the effect of the inflation problem. You know, after the big inflation push up, those companies have raised prices significantly. Consumer are reacting. You have some developments that are not necessarily positive in the very short term. I tend to believe that you need to keep your staples. It's too late to sell, but I would not necessarily reinforce this exposure right now. When it comes to durable, I would more look towards Europe in this case, because the auto sectors is not necessarily a sector I would favor in 2025. Look at what is happening in the luxury stocks in Europe over the last few days or 2 weeks. They are going up quite significantly. I think that there is renewed interest for these sectors. It's connected to the fact that, as you mentioned, the US economy remains very strong and that there is potential for consumers to remain strong. And you have development in China that are, I would say, positive because the government seems to have understood that they need to act on the monetary and fiscal front to do something to support economic activity. This morning we had the CPI numbers, they were poor. So really this deflation threat is increasing. So I think that they are going to act more strongly to support. So it's helping the luxury sectors. And don't forget that from April until November, the luxury sector was one of the worst performer on the market. And suddenly there is some window dressing and people are getting back some interest into the sectors. So it's more towards Europe that I would look.
All right, let's talk about Europe now because Europe has been seriously lagging behind the US, especially France. I think France is the only main index that is negative on the year, and in fact, France is down more than 10% since the elections they held just before the summer. Are you expecting Europe to remain undervalued compared to the US next year, or is it time to up the ante a little bit and rotate a little bit into Europe?
I think I would be on the second part of your question. Seem to be the relevant issue for me. I think that the underperformance of Europe is quite significant, and it's not necessarily justified on all front. There is something also that we need to be aware. With the good economic numbers coming from the US, clearly the path of interest rate cut in the US would be lower than what was expected 6 months ago. On the contrary, in Europe, the monetary support from the European Central Bank is going to remain quite important. The valuation of the European stocks is quite interesting compared to the one of the US. And I think that you have the financial sectors in such an environment, which is a big part also of the European index, is going to take advantage of the, I would say, improved interest rates environment. So I think that you have the condition, at least for not seeing Europe underperform as much as it did in 2024, and to recover a little bit of this gap. So that's the reason why I think that you could increase European exposure.
What do you think of Switzerland then? Because Switzerland hasn't exactly been going gangbusters either.
It's connected to the fact that the main components of the index are very defensive by nature. The Nestlé, the Roche, the Novartis of the kind represent a significant part of the index. Nevertheless, I think that this week we will have the Swiss National Bank cutting interest rates. I think it's quite clear it will be at least 25 basis points. I think that the monetary trend is still supportive and positive. I think that it should support, again, the continuation of solid performance of the financials. Look at some insurance companies, some banking companies. They have performed quite well, and I think that the environment is going to be supportive for the Swiss market next year.
Coming to, you mentioned China just a few minutes ago. In fact, when there was that bounce in the big bounce in the Chinese market, you cautioned against rushing into investing into China, and you've been correct on that because the market's been consolidating. It's gone nowhere since that period. Do you expect the Chinese market now to build on that consolidation after the events of this morning?
It depends if they really do concrete measures, because with the Chinese, we get used to the fact that there were big announcements and they were not necessarily followed by strong measures that are necessary in order to fight the deflationary risk. Deflation is the worst outcome for an economy that's full of debt. And don't forget that you have a debt issue in China that is the real estate debt, that is the state or local government debt. So as long as I have no concrete measures that are announced, I take note of the intention, but I do not change my stance on China, and I would not chase China right now.
Turning to currencies now, what are your thoughts on the dollar, which has been very, very strong ever since the results of the elections, really?
I think that it's too strong. I think that the fundamentals are good because the economy is very good, but nevertheless, it's overvalued. I know that people believe that because of, as I mentioned earlier, there will be some discrepancies between monetary policies in the US and in Europe. The euro can only go down. I tend to disagree with this idea. I believe that most of that element is pricing the price of the euro. And I still reckon that the US dollar is going to be above 110 1 year from now, because at the end of the day, I don't see the US Trump administration being very dollar supportive. They know that it's not a key issue for them. They would like to see the dollar weaker. And I think that you need to be careful with US dollar. And in general, I think that people need to be aware that this environment where monetary policies between the different blocks, the yen with rate going up in Japan, euro going down, US hesitating, it can create a lot of forex volatility. Forex volatility is not necessarily something that is very good for equity market, or at least it produces volatility on the equity market. And this is the kind of environment that I expect for 2025.
Turning to back to US stocks, if I may, and for those of us who still look at Dow Theory, the Dow Jones Transport Index has been lagging the Dow Jones all year. Is that something that surprises you, or is it well? Yeah, answer it that way first.
Think that it's always something that you need to check, but I don't think that this indicator, because at the end of the day, what the people have in mind is when the DG transport is going down and the DG transport, the Dow Jones is going up, it means that there is a gap that is created. And usually at the end of the day, the Dow Jones follow the Dow Jones transport because the Dow Jones transport represents cyclicality. If economic conditions are good, the DG transport should go up, supporting the Dow Jones in general, and the inverse if things are going wrong. I think that the environment has changed. We are not in an environment or a market that is driven by cyclicality. We are in a market that is driven by a revolution, an innovation, which is called the artificial intelligence. So the fact that the Dow Jones transport is going down is not worrying me too much. What is the key question that people need to have in mind? And you have a lot of people speaking about that lately. It's the fact, are we facing a kind of overinvestment in the artificial intelligence theme? You had a huge amount of money that were spent by the big seven to support the AI revolution. Is it an overinvestment? Are we creating overcapacity? I think that this will be a question that will be with us during all 2025.
Where do you see the main risks in 2025?
I think inflation remains to me something that we need to observe because people get, to my point of view, too condescending towards inflation. They have the impression that the disinflationary trend cannot be under threat in the coming quarters. On that, I would be careful. The tariff issue remains with us. We also see that you could have geopolitical development that could induce some inflation threat in the medium term. Look at what happened in Syria over the last few days. This is something that is important. This is something that could have significant effect on the region, and it could potentially create some destabilization, and it could have some impact on prices. So inflation to me is something that that's a risk, that suddenly inflation is stronger than many people expected in the US in particular. I think that the monetary policy coordination is something that is going to be very important also, because if you have those divergences between the different monetary bloc, people need to be careful. I think that, as I mentioned, the test on the overinvestment in artificial intelligence is something that is very important. Geopolitics will remain a significant factor. I think that in Europe, the key elements is the risk is that Europe lost it, because we will have the election in Germany, we will have this instability in France, but at the end of the day, next year is a very important year for Europe. They need to move forward if they really want to make something out of the European project. And they don't have a lot of years in front of them in order to react.
Francois, I think that's all we've got time for. Thank you very much indeed. And I look forward to seeing you next Monday.
Thank you. Have a good week.
You too. Bye bye.